Robert Ethier, co-founder and managing partner at Impact Science Ventures.
And what are you guys looking for? What's your thesis or focus?
Yeah, so where we invest is very early stage scientific breakthroughs that are driving industrial innovation.
Mm-hmm. And where did this idea come from to start investing in this space? What's the origin story of your company?
It started about 10 years ago. I had a background at that point as a decade or so as an institutional investor, investing across asset classes. My focus was really identifying long-term global macroeconomic themes and figuring out where in the capital stack we should be deploying our investments. In that seat, this lined up really well with the Clean Tech 1.0 timeline, that 2005 to 2015 period. I was able to see a lot of technologies that were trying to be commercialized at that time come across my desk for investment, but in reality, the economics just never made sense. At the end of the day, if you are trying to sell things that are essentially commodities, energy, materials, yeah, you can show you have market traction within a niche market and that it's growing, but if you're working in commodities, you have to have mass market adoption or scalability in order to be successful. So for me, none of these ideas really made sense back then. My focus on these, or my opinion on these types of technologies really started to change in the 2015, 2016 timeframe. Again, from a macro perspective of seeing the cost of renewables come down the cost curve and beating fossil fuels head to head in certain places at certain times, but those places and times only growing. At the same time, you have this idea of long duration energy storage becoming economically viable within the next 10 years or so, and we're at that point now. The third thing that really drove this was my investing background on the industrial side, seeing energy as a key input for any production process. So looking at the future of industry, if there's a cheaper energy input, industry will switch, not for any kind of a sustainability mandate or a green mandate, but strictly to improve profit margins. For most industries, though, there is some sort of a technological advancement required to make that switch. So for my seat, this looked like a once-in-a-multi-century type opportunity to be on the ground floor of creating new industrial titans. I liken it back to the 1870s in the US of imagine if you were a Series A investor in Standard Oil, Carnegie Steel, Edison Electric, Dow, DuPont, 3M, all these massive corporations that were created over time because they had advanced technology. And I feel like we have that opportunity now. So I took that thesis. I knew there was not the risk appetite within my existing firm. I moved to San Francisco, did MBA at Berkeley, was recruited into a wonderful organization called Activate that really helped catalyze this thesis and allowed me to launch it. So Activate runs a fellowship program on behalf of government and philanthropists. They recruit scientists into an organization where they can co-locate their companies inside the US national lab ecosystem. They're fully funded for 2 years. That includes salaries and health insurance, R&D funds, and they get a team around them to help build them from PhD to CEO. And that was the team that I was part of. While most of my work was on mentoring the fellows and helping them close venture capital deals, I was also tasked with working on a DOE research grant, researching Clean Tech 1.0 to figure out where investors went wrong during that time period and how you could be a more effective investor going forward. That research, which included a lot of public information, but then interviews with founders, investors, employees of those firms, what their technology development pathway was, what their financing pathway was, what the exit story was, pulling all that data together to build a different kind of venture model to invest in these types of technologies.
So who are you investing in? Who are you investing in? What are you looking for? What's the sweet spot for you guys?
Yeah, we love the things that most people don't. So we're looking at heavy industry. We're looking at old industry. We're looking at things that people may ignore because they are so old and so commoditized. But if you're telling me I can go after the energy market of a $2.5 trillion global market value, or go into steel with a $1.5 trillion global market value, or cement with $500 billion, copper with $300 billion. If I can go into these markets with new technology and sell the exact same product in the same way to those same customers at a lower price point, I'm going to win every market and I'm going to have a massive market potential.
So what stage would you normally invest in at then? Where do you normally start writing checks?
Yeah, so we'll come in very early stage near company formation. We'll run kind of at this stage, more of a standard VC process of spending a few months with the teams, We have to be excited about the team itself, the founding team, the technology that they're trying to push out, and the market they're going after. But this fourth pillar that separates us from other VCs is we know from our experience as investors and founders, and based on my research on Clean Tech 1.0, that going from very interesting lab-based research to commercialization, or something that works outside of a lab, some kind of a prototype, we can prove the science does work in the real world, can be a multi-year, multi-million-dollar process. It's a very risky way to deploy equity dollars. So what we do is we'll layer in very small of equity amounts at the very earliest of stages, assuming that you also have the resources available to you to de-risk the science side. And that's typically coming non-dilutive, which is why we have these partner programs we work with, Activate being one. There's these other lab-embedded entrepreneurship programs that we work with at other national labs, where they're providing those non-dilutive resources. So we love investing in companies like that because we know they have the resources available to them to actually de-risk that science with a clean cap table.
So the science mustn't be like commercialized the stage when you guys get involved.
Correct.
It could be still a research level.
This is coming out at, we've done, typically the stage is like a TRL 3, Technology Readiness Level 3, and that we've done some experiments, we've had some great results. And from our industrial knowledge, if we were to apply this technology to this industry, it could be a game changer. That's what's getting us excited.
Mm. And how do you get conviction that they will go on to become fully commercialized? TR level 9,
yeah,
right?
Yeah, we like to get to a TR level 6 before we're deploying our second stage of investment. So we didn't touch on that. We deploy in 2 stages. So we have what we call our scout program, where we're writing 100K checks very early on near formation. We then run a 1 to 2 year diligence process with those companies we've invested in, where we want to introduce them to suppliers and hires and customers, co-founders, and get this very in-depth view of how that company is developing, how the founding team is developing, how industry is viewing that technology before we're writing a larger check into the next round.
And how big is the pool of money that you're investing from? You raised one fund or multiple?
So we raised our first fund in 2021, raised $25 million. We called it a proof of concept fund because the way this fund is investing is so different from your typical venture capital deployment schedule. So we call it proof of concept. That concept has returned quite well so far. And so now we're coming back with our first institutional fund, targeting $100 million now for our fund 2.
Okay, very exciting. And can you give us some other highlights in terms of number of checks you've written or any success? I know it's still early days, but anything you can share there in terms of traction or?
Yeah, so the way we looked at that, our fund 1 was targeting 35 of these scout investments and then 15 what we would call core portfolio investments. And so this portfolio is 3.5 years old at this point. We have 2 unicorns in that portfolio. We expect to have a third by the end of this year, early next year. We think there's a fourth that's in line for the year after. And so if you're looking at a early stage fund with 4 unicorns in a single portfolio that you've identified after 3 or 4 years, it seems like we're doing pretty well.
Mm-hmm. So how would startups thinking about fundraising get in front of you guys? How do you source your deal flow effectively? So you mentioned some partners, but...
There's 2 funnels we look at. So one is a direct funnel. So we have a pretty good reputation at this point, and we have a lot of portfolio companies that we've worked with. Those founders are typically coming out of grade A, very high-level academic labs and national labs. And so when their colleagues go to start companies, they'll often make those introductions to us. So that's one side of the funnel. The other side of the funnel, which is probably 2/3 of our deal flow, is working with these partner programs, typically located with inside national lab facilities, where they're running a recruitment process. There's probably 1,000 companies or more per year that are going through them. We're actually volunteering our time to give feedback on those companies as they're going through that process. And what that does is it allows those programs to choose better companies and allows us to get these first look at potentially game-changing companies.
And how many checks have you written so far then? What's the plan?
We have, so in Fund 1, we've written a total of checks into a total of 47 companies. For Fund 2, we're planning on expanding that, looking at 50 to 75 scout companies, but still just 15 core portfolio positions. So the next 3 to 4 years, we'll write approximately 25 investments per year.
Okay, so you must have seen quite a few startups and a lot of pitches to get to that kind of number. So maybe some advice to the entrepreneurs thinking about fundraising, good, bad, and ugly. apart from having exciting technology and the other things that you mentioned, what would you recommend? What have you seen working well in the past that you'd like to see more of going forward?
Yeah, for the ugly, I'll start with, you can save yourself a lot of time by doing this. Do a patent review, do a patent search to make sure that whatever it is you're working on hasn't already been patented, that someone isn't already commercializing that. It can be tough to get good intel on what startups are doing, but you can at least do a patent review and look for it that way. We've seen companies come through where they think they have a great idea, and as it turns out, like, we already know someone with a patent that would prevent you from working on that. The bad is coming with a pitch that focuses on just the technology. I know coming out of your PhD program, you've worked on this for years, and this is something that you love, it's your baby. The reality as an investor, I care about the solution. I am technology agnostic. I want something that's a better solution that exists in the market today. So if you're focusing on how great your technology is and you've lost sight of what market you're going after or what your techno-economics look like, that's going to be a miss. And on the good, if you come with a pitch that is customer focused, so focus on what is a problem that you're solving, how are you solving it, and why is no one else solving it this way? That's going to be a good pitch. The technology, we can discuss that in diligence, but let's talk about the solution first.
Good, some very concrete examples there. You mentioned you started out a few years ago. Clean tech is still kind of emerging. Would you agree with this analysis that ESG has sort of became trendy and now has almost reached a peak where some firms are sort of proactively stepping away from leaning into ESG? And obviously we have a new president that's not sort of a big fan of clean tech per se. What's your take on timing and trends within ESG and clean tech in general for yourselves and for your startups?
Yeah, so I think there's, thinking about the new administration, I think there's 3 ways to think about this. One, if you are investing in solid businesses, if you're investing in businesses that solve a real problem, you're going to do well regardless of administration. So especially within clean tech and within industrial innovation, you need to be investing in things that are successful without government subsidies, without tax incentives, or in the current administration, without tariffs. If you invested in a company that required a subsidy or tax incentive to be successful, that's a very high risk point. And with the new administration coming in, that risk is being realized. At the same time, it goes the same way with tariffs. If your company is only going to be successful with a 15% tariff or 20% tariff on Chinese goods, we all know that can change in a year, 2 years, 4 years. So with the stuff that we're investing in on the industrial side, if you're looking at long-term capital planning, you're not going to build a 50-year plant life or a plant with a 50-year life based on what tariffs are today. You need to know you can compete on price over the long term without tariffs or subsidies. And if you're investing in those things, it doesn't matter how the winds shift on ESG or with the administrations. You'll just have a good business that solves problems. On the second piece is a lot of what we do within the industrial innovation space is still aligned with the new administration's priorities. And I think that probably aligns more in clean tech than people might think in terms of, okay, if you want to be able to manufacture here, all right, we want to bring onshore or reshore manufacturing. That's a big priority. If you want to be able to actually have supply chain resilience, you're going to have to make those raw materials here. Again, that's onshoring and reshoring. And then if you, as you're investing in these technologies, you're typically looking at ways of doing it that are more efficient. So things that we get excited about is looking at, again, a commodity market where we can do this with resource efficiency, when we can do it with less energy. And if you have those 2 things, you're typically going to have a better environmental impact. I'd like to use an example on this, if I can, of thinking of steel or copper. This country hasn't built an integrated steel mill in over 60 years. It hasn't built a new copper refinery in over 50 years. We used to do those things, but we shipped them off to China and other places. Why? Lax environmental standards and cheap labor. Even if you got rid of the environmental standards in the US, EPA is gone. You can pollute wherever, however, there's no cost to it. You still would not build a copper refiner in the US using today's technology. It's still too expensive. And if you said, well, we have tariffs, why am I going to invest in a 50-year plant with a 50-year life for tariffs that might change in a few years? So the only way you're going to bring these industries back, steel and copper and others, the only way you'll bring them back is with new technology that does it better in terms of resource efficiency, in terms of energy efficiency, and in terms of environmental impact. And fourth, and most critical of everything we look at, you compete on price. You compete on price without subsidies, without tariffs, and you win the market. That is how you bring things back. The third pillar here with the new administration is the energy transition is happening. It doesn't really matter what policy does. There was a great Nextera, one of the most valuable utility companies in the world, just published their annual report a couple of weeks ago. There's a great chart in there, slide 6, I think, that shows the cost to deploy new generation assets and the timeline to deploy new generation assets. And this is in terms of when they're thinking of their customers demanding more power very quickly for data centers. You can deploy renewables with storage for less than half the cost of a new natural gas facility in less than half the time. And if you compare it to nuclear, it's even better economics. So if I need to deploy energy fast and I need to deploy cheap, I'm using renewables. Yes, we're absolutely still going to deploy new natural gas. It's going to make for baseload power. We'll also combine that with geothermal and nuclear. But if I need to deploy fast, it's going to be renewables. And you're seeing that even without economic incentives, wind and solar are going to be the major new energy developments on our grid for the next at least 5, probably 10 years before nuclear starts kicking back in.
And looking beyond the US, I guess there will be trends with regards to ESG coming and going at different rates in different places. How do you think about working with startups that are kind of diversifying their customer base, maybe working with Canadian customers or government equivalent sort of departments, etc., or in Europe? How do you think about that? Is that something you factor in, or?
Absolutely. So we've done more international expansion recently of looking at international markets for both our companies, for potential deal flow, potential investors. And it is interesting whether you're in other places in North America, whether you're in Asia, whether in Europe, this push towards the energy transition hasn't stalled at all. Yes, within the US, you're probably going to see fewer heads of sustainability. In Japan, absolutely not. In Canada, absolutely not. Anywhere in Europe, absolutely not. They're still pushing ahead, and I think on the economic side, it makes perfect sense because they've seen how do we deploy cheap energy quickly? It's going to be renewables. And if we can start powering something that was, powered by heat, by fossil fuels in the past, and we can switch to renewables and do it for half the cost, why would we not do that?
And to wrap things up, to finish on a positive note, why is this a great time to be a climate investor or a climate startup? Any thoughts on that?
Yeah, so one, I love being a contrarian. So as if we call it clean tech 2.0, as investors are less focused on this area, that just means I have more deal flow with less competition. So I love that fact about investing over the next couple of years. Second, and more on the macro side, is most of these technologies that we're pushing out today, that we're about to commercialize, actually spent decades in the lab before they became commercially relevant and before they finally picked up the investor interest to actually attempt to commercialize them. There's a lot more out there that we haven't touched yet. Different technologies that have been developed that are now getting to be commercially relevant, where we should start looking at them to go disrupt existing industries. And if you look at things like, I keep saying it, but cement, steel, copper, a lot of these industries are using the exact same technologies they used 50 years ago, 100 years ago. So there's a lot of low-hanging fruit there that we can go and disrupt.
Robert, thank you very much. Appreciate your insights.
Thank you.
Thanks.